So absolutely, the yield curve is a major factor, and often what happens when equity markets suffer, you're seeing this movement from equities into debt, and that risk-on environment is certainly causing a very strong demand for Treasuries, which, as you say, has pushed 10-year Treasury yields back below 290. What's so interesting is that because of the impact of G20, especially because they removed what they often have as a reference to a statement around elimination of protectionism, as well as concerns that the Trump-China scenario might take a lot longer to play out, is definitely dragging on the markets. And I feel that we need some idea that resolution will occur for us to see a bit more confidence returning into global markets. So it's also an unusual time because traditionally when we've seen inverse yield curves, they've been a really good pointer of recession. But we haven't had an environment where in the post-2008, what we call the GFC, the post-global financial crisis, you've had so much QE going on, so much investment by central banks in the bonds of their own countries, that it does make it much harder to tell if the chance of inversion of yield curve is pointing to recession or not. But there are more indicators that next year's rises by the Fed will be limited to 2 rises. That's in addition to the Fed rate rise next week that we expect. And as those future rate rises are being priced out, that's why you're seeing a very strong rally in the longer end of the curve.
Leigh, this is the point that we keep talking about. It's the extraordinary stimulus. It's also what's going on the supply side of Treasuries, given the fiscal stimulus in the United States as well. I mean, are you in the camp that says this time is different and we shouldn't necessarily fear the signals coming from inversion?
Yes, I am a believer that this time could be different. But what I was really impressed about when Powell spoke last week, and when you look at the recent speeches by him and Clarida, and you look even at the minutes of the FOMC, they are just talking so much about moves up being data dependent. So we really need to understand how well the economy is doing, and it means that event risk is heightened. So for example, things like the OPEC meeting tonight, things like US unemployment tomorrow night, which will give us a real understanding of how the economy is doing, are going to be that much more important, as well as seeing where fourth quarter GDP comes in at the beginning of next year.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.